Hi, thanks so much for joining in. You're watching the Mutual Fund Show, and my name is Alex Matthew. Like the name suggests, this show is geared towards getting you information, actionable information that will help you make the right choices when you're investing in mutual funds. And we have a host of topics that we normally discuss, but given the kind of experience that you've probably had over the last week and a half or so, with the kind of chop and churn in the equity markets, I'm sure a lot of you are wondering, with the dust now showing signs of settling, how you should position yourself going forward. What are the aspects to focus on? Because the political theatre over a period of time will wind down at least a little bit. To talk about that and more, I'm joined by Kalpen Parekh, who is the Managing Director and Chief Executive Officer at DSP Mutual Fund. Kalpen, thanks as always for taking the time. Always a pleasure having you on the show. You know, before we start with some of these aspects, with positioning yourself and identifying how to build and maintain your long-term portfolio, I'm actually curious about what you think about some of the latest data that has come through from AMFI. And just interesting about that SIP number, first of all, which is close to 20,900 crore. Since July of last year, we've been seeing all-time highs every month, but we've also come to know about the net number, which is much lower, of course, than the gross number. And so is it, do you take this data as a representative of the industry with a pinch of salt?
Thanks for inviting me again to your show, Alex. And like you mentioned, a lot has happened in the last 3 weeks or so. Actually, I've been immune to that because I was on 2 holidays. I've just
lucky you, Kalpen.
I left when Nifty was at a level and it's back to the same number. So actually, nothing has happened for me, and that is how investing should be.
Yeah.
Coming to the SIP numbers, you know, this data has been there forever. You know, for many years now. There is a ratio of around 40 to 50% in terms of the gross to net. So the 15 to 20,000 crore gross number that we see every month is the new SIPs that are coming in from a different set of new investors who are joining the industry. And finally, when you see the net number in, you know, closer to 8 or 9,000 crores, there are some old SIPs which are completing their tenure. There are certain SIPs where the investor may have a cash flow need and he's stopping his SIPs. So this has been a common trend for a long period of time, and there's nothing unusual that I would read into it. It is business as usual. There is always this leakage. I won't use the word leakage. It's actually closure or end of SIP. So let's say if in 2015 I'd done a 8-year SIP, that 8-year SIP is getting over, and that's why it's not getting reflected in the next round. So nothing to really read too much into it, according to me.
I'm glad that you pointed that out. But yeah, and before we get into, again, the portfolio side, 1 or 2 other aspects struck me in today's data, which is the kind of flows overall into equity mutual fund schemes. And I'm talking about the actively managed schemes, well over 30,000 crore rupees, in fact, closer to that 35,000 crore rupees, but a large amount going, Kalpen, into thematic funds. We're talking about one NFO, of course, but that accounted for about 9,500 crore rupees out of 19,000 crore rupees, which is very substantial. What does that tell you about the objective or the expectation of the mutual fund investor?
So, see, SEBI has created various buckets, right? Large cap, mid cap, small cap, and anything which does not come into this bucket or which is a very, you know, narrow idea or theme comes in the thematic bucket. And in the last year or so, in fact, it's not just this month, Alex. In fact, when I was presenting to my board a few weeks back, even the year-to-date number, the largest flows have gone into either thematic or small and mid cap as a category. And some of the themes which have been at play for the last 2 or 3 years have delivered superior returns. So, in fact, except banking and consumer and tech, all other thematic strategies or funds have delivered significantly higher returns than Nifty, and you know, almost to the tune of 20 to 25% CAGR in the last 3 to 5 years. Now, what does this indicate? This indicates the iron law of fund selection that human beings, you know, bring to the fore always, which is most of us invest for the future looking at the past. So in the last few years, thematic funds have delivered superior returns. And in current times, thematic fund NFOs are also garnering a large amount of assets. That collectively is reflecting in this larger chunk of thematic flows. Now, part of it, if done thoughtfully by knowing what theme you're buying with what type of risk profile, is absolutely fine. But I do worry at times if investors are buying into hot themes at the peak of its cycle without knowing that these themes have, sharp cycles, and they can go through extreme amounts of volatility. So mostly, if you talk to any one of us in our industry, we always recommend diversified funds, flexi-cap funds, multi-cap funds. Thematic funds need to be timed well, and the best time to invest in a theme is when it does not feel like the best time to invest, which is the last 3 year returns are not looking that great.
Well put. I'm just going to take a chance and get your opinion on this, because I think a lot of investors, Kalpen, are upset about this, and they tried to buy the dip. It's said very, vociferously every time we speak on television, buy the dip, buy the dip. And when they tried to do that on the 4th of June, some of them that tried to invest got the NAV of the next day, not through no fault of theirs. And I'm guessing through no fault of the mutual fund industry either, because they received the funds after the cutoff time. But is there something that you think can be solved? I know that you may not have a solution for this, but I'm still curious of your opinion.
See, I think, and I don't have really a full color to this in terms of, what amounts of flows did not get participation on that day. But there are two things to keep in mind. There is a need for aggregators. So the ideal condition is that I have money. So I bought on that day, for example. I was in Goa on a holiday. Markets were down 5-7%. I went to my mobile app of DSP and I chose 3 funds, and I transferred money. In 1 minute, all the 3 funds, the money was transferred, and I got the end of the day NAV. So there is one way of investing which you go on the platforms directly and get it. Now there is another way where you have to go through aggregators, and there is a huge role that aggregators play, because not all banks have API linked in such a way where money can transfer real time. So there are many banks around the country, some private sector banks, public sector banks, cooperative banks. Now all banks do not have full transmission real time. So in fact, even I've asked my team to see what can we do so that in future this does not happen. And it was a 4% fall. What tomorrow it could have been a 10% drop and 10% rise the next day. That would have meant a significantly large loss to investors for no fault of theirs. So we'll have to investigate, figure out where in the process is this leakage happening, where is the money getting delayed from, transferring from investors' account into the aggregator and through the aggregator to the mutual fund scheme account, and see how we can solve for that.
Point. Yeah, I'm guessing everybody is trying to find a resolution, and in fact, I guess at some point the regulator might also have to step in to identify what needs to be fixed. But let's go to the topic that I promised. And I thank you so much, Kalpen. You're such a sport. You've taken questions on topics, everything apart from what we had agreed to speak about. But let's talk about building a portfolio or maintaining a portfolio, because after such important events like we've just witnessed over the course of the last couple of weeks, it also pays to take stock and to reposition if so. So if we're looking at the next 5 years, Kalpen, what do you need to bear in mind?
I think from a long-term investor's perspective, what we have to bear in mind is that we are here to invest so that we can beat inflation and increase our purchasing power. And the best asset class which has done that so far in history has been equities. And equities, again, do not always make money. We recently released a report through Netra, I think a month back, which highlighted that in many countries, 10-year, 20-year, 30-year returns also has been negative for equity as an asset class, or returns have been lower than fixed income, or returns of that stock market have been lower than gold in their local currency terms, because currencies also tend to go through phases of decline. In case of Indian investors, we have been very fortunate that 2 things that matter for the health of our money. Corporate India continues to grow profits in a return in a ratio of 10 to 20%. So in bad times, we've seen our economy, whenever it has slowed down, profits have grown at 10 to 12%, and in good times they have grown at 18 to 20%. So on an average, over the last 25, 30 years, we have seen 13 to 15% sort of profit growth rate for corporate India. So if we are shareholders of this profit growth rate, more or less that transfers into our long-term return. Now, this number can get either diluted or enhanced depending on what price we pay for this 13 to 15% profit growth rate over a long period of time. So one is the profit growth rate, and the second thing is the ROE of corporate India. So if there are 500 companies in Nifty 500, and most of us as mutual funds invest in 250 of these 500 companies, the ROEs of most funds again are between 18 to 22%. So around 14% growth, profit growth, around 18% ROE. This is what you are buying as an investor. The only variable that changes, the outcome from a return point of view is what price we are paying. The price that we are paying to buy this profit pool and this ROE today is around 21, 22 times. It is slightly expensive than what it should ideally be at. Now, what is ideal according to you and me may not be what the market wants. So the market can remain less ideal at different points in time. So right now, the only thing that can reduce your returns from this growth rates is the higher valuation. But if you have a 5 to 7 year time horizon, time takes care of most of these challenges. Overvaluation can be solved for by two things. One, by introducing 2-3 other asset classes, which in a way reduce the impact of overvaluation. So if you add some bonds in the portfolio, if you add some global stocks in the portfolio, if you add gold in the portfolio, it somewhere will solve for overvaluation on one side. And the other part of overvaluation can be solved by time horizon. So what return you would have earned, let's say in 5 years, you may end up earning in 6 years. So your returns could get marginally moderated. But I don't think Indian investors need to worry if they have a 5 to 7 year time horizon, because we have two things going right for us. Our growth rates are reasonably stable and durable compared to many parts of the world. And our macroeconomic stability has never been as good as we have seen in the last decade. So our currency is stable, our deficits are stable, our inflation is stable. Policy making has been reasonably disciplined all through periods of shocks in the last 5-7 years, whether the shocks of demonetization, the shocks of COVID. Our policy making has never been at extremes compared to rest of the world. So these few dimensions tell us that our returns could get moderated, but we don't have to worry too much in terms of significant volatility. We could have marginal volatility at the margin, and which is why we recommend hybrid portfolios which blend multiple asset classes at this point, only to solve for the slightly higher valuation which exists at this point in time.
To come to that, exactly. In fact, if I remember correctly, either at the start of the year or towards the end of last year, we had spoken about something similar, and you'd said that hybrid is a good way to go because of the blending of these aspects, and that seemingly continues to be the case. But if you are to do it yourself, Kalpen, and if you are to have a blend of equity and bonds, then what should you bear in mind on the fixed income side, on the bond side, based on everything that you're seeing, all the moving parts?
See, again, in fixed income today, the 10-year sovereign bond, which is the best quality bond in the country, is at 7%. Normally, it fluctuates in a range of 6% to 8%. These are the broad boundary conditions. We are somewhere in the middle. Now, from 7, it can go higher. From 7, it can go lower. The odds are it will remain stable with a downward drift, because normally bond markets look for parameters like stable inflation, stable currency, and the demand supply of bonds. So every year the government needs to borrow more between 10 to 12 lakh crores via auctions. Now, in the next 2 to 3 years, there is enough demand from domestic investors as well as global investors for India bonds, and that demand is likely to not just match but be higher than the supply that is likely to come from more issuances either by Government of India or by corporate India. So interest rates are likely to remain at stable rates at 7%, with a bias for them to be lower 1 or 2 years from now. Now, if rates fall, the investor not only earns the 7%, but can earn between 1 to 2% more in terms of mark to market. So there are reasonable chances or probabilities that the investor could earn more than the current carry. If rates were to rise, he would earn 7% minus mark to market. If rates were to fall, the investor would earn 7% plus some mark to market. And at this juncture where we are poised right now, where our currencies are, our currency is fairly stable, our inflation is reasonably stable, deficits are reasonably under control. As long as government behaves well in terms of fiscal policy, and the RBI, has the pragmatic monetary policy that it has played out in the last 4 or 5 years, I think our interest rates are unlikely to see any negative upward bias. And hence, bonds can earn between 7 to 9% return in the course of next 2 to 3 years with reasonable amount of stability. So I think a bond investor just needs to keep in mind that he's not buying credits without understanding or going below in terms of inferior quality of corporate bonds. Yeah. Because there are only two things to keep in mind, interest rate risk and credit risk. Yeah. Interest rate risk reasonably stable right now because of the setup we are in. Credit risk, the investor has to ensure that you don't make the mistake that we all made in the last cycle, where we gave money to so-called AAA names, even without really looking at cash flows and balance sheet and governance and those parameters. Yeah. But I think if an investor were to just buy the sovereign bond or even a gilt, or if not do on his own, but give it to a hybrid fund where the fund manager will help you blend these two asset classes and take you over the next 5 years.
Fantastic. Kalpen, always a pleasure speaking with you, and I look forward already to the next chat. Thank you so much for taking the time.
Good day. Thanks, Alex. Bye.
Amit Kukreja, the founder of AmitKukreja.com, is joining us on the program right now. Amit, thanks as always for taking the time. And specifically speaking about that June 4 issue that so many people have spoken about, did you have people that you interacted with that pointed out the same issue?
No, so the issue was not pointed out, Alex, but a couple of clients did reach out saying they wanted to invest money today, as when the counting was happening and the market had already fallen decent 6-7% that day. And we did submit the purchase orders. And you see, in mutual funds, you get the end of the day NAV, and thankfully market closed about 5% or 6% lesser than what it started with. So the dip was able to be capitalized in some of the clients' portfolios. But if the market had risen back by the time the closing bells have rung, then the dip would not have been capitalized in the mutual fund investments portfolio. And we checked, the NAVs were assigned as of 4th of June, so no issues on that front. But I heard there were issues reported by several other advisors where some of the mutual funds were not allotted the NAVs of end of that particular day, but were allotted the NAVs of the subsequent day when the market had already come back up by 3 to 4%.
So just so that we're all on the same page and my viewers know what we're talking about, what are the thresholds and what are the cutoff times that we should focus on, Amit?
I think for equity mutual funds, definitely before 2 o'clock we should go for. I think the cutoff is 2:30 or 3. But we normally go for 2 o'clock because at times we have seen there are a lot of intermediary connectedness issues with respect to infrastructure availability. Sometimes the transactions do not go through. For debt funds, we keep 1:30 p.m. internally at a firm level as a cutoff time. But I know the time communicated to us is 3 p.m. For equity and debt. But we keep it before 2 o'clock.
So, I was actually thinking about this, and not to belittle the issues that have been pointed out, but in the larger scheme of things, Amit, my question to you is, if somebody has missed the opportunity of investing at the low point of the 4th of June, unless it's a very large amount of money that is being invested, have you lost anything dramatically if you're talking about the longer time frame?
No, you haven't. See, if you're looking at the trend of over a period of 10 years or 8 years, these are little glitches that you will easily be able to, capitalize much later, depending upon your holding period. Because if you're missing out the dips, I'm sure you will miss out the wrong windows to sell also. So you cannot calculate all these opportunities and put a mathematical value against them. But you can just keep a trend in mind that if I'm in a good macro situation where the economy is expected to do well next 10 years, these dips will keep coming, but we will have a continuous systematic purchase plan either through SIP or through STP in mutual funds. And we will ride the wave of volatility and do the cost averaging on the basis of that rather than by timing the market. Nobody can time the market perfectly.
I do want to talk about buying at a specific price point though? Because in the passive segment, at least, Amit, we're talking about index funds versus ETFs. And the advantage of ETFs, of course, is that it offers you the opportunity to buy or sell at a specific price. So if you have an event like the 4th of June, and if you absolutely need to get a specific price, is it a better avenue to look at ETFs?
See, if you're trying to take advantage of the market dips during the day, then ETFs definitely give you that advantage over mutual funds, because in mutual funds you get the end of day NAV. However, in ETF also you can't just buy. You will have to put a limit order, right? At this price or lesser, you'll be able to buy. Otherwise, you'll miss the order. So you, based on the limit order, or you do a market order transaction like what you do for stocks, exactly same approach is required for ETF. It's very tricky. The ETFs can marginally give you better returns than index funds, but in the long run, the difference averages out to very, very minimum number. So stocks and timing this stock, or trying to find a stock or buy a stock at a dip, might be a better or rewarding experience than trying to do that with ETF, because the ETF at the end of the day is a collection of stocks, which is an index, which is a very passive strategy of building your investment portfolio.
That's a fair point. We did incidentally have a question from Debapriyo Sadhu, who's aged 58, and he's asking what the difference between a mutual fund and an exchange-traded fund is. And you've broadly answered the question, but in your study of it, are the costs lower for exchange-traded funds?
So ETF definitely comes out to be lesser expense ratio than mutual funds. But if I'm having a strategy to buy ETF, then I will also look at my demat account cost, the brokerage that I'm incurring for doing the transactions. And in some cases, it turns out to be an overall more expensive affair than the index mutual funds, where everything is taken up, where everything is looked after by the fund house, by the asset management company that is managing that ETF. So it depends upon what ETF you are choosing compared to the index fund of that index for which you have chosen the ETF. Broadly, it comes out to be the same, and in some cases, ETF turns out to be an expensive affair if you look at all the overall cost of demat and transaction. But if you're looking at only passive investing through mutual funds, your mutual funds will come out to be cheaper if you compare the overall cost of ETF and managing an ETF-based portfolio.
I think we have time to take one more query, and that's coming in from Partha Mitra, who says he's 56 years old and he's looking to build a retirement fund. I do not know what his overall corpus looks like, Amit, but he's thinking of starting an SIP of 10,000 rupees in the HDFC Mid-Cap Opportunities Fund. He's got a time horizon of 5 years and he's aiming for an overall corpus of 1 crore rupees. What should he bear in mind?
So Partha, as I see, his age is 56. I don't know what is Partha's experience in mutual fund investments is. If he is a seasoned investor, he can definitely start investing in a mid-cap fund. HDFC Mid-Cap Opportunities is a good fund. But remember, for a mid-cap investment, you have to have a minimum holding horizon of 8 years. The longer, the better, because your returns are going to be much better. And so for 5 years, if he's investing about 10,000 a month at 14% CAGR, he's likely to accumulate 8.5 lakhs approximately.
Fair point. All right. I hope that answers Partha's question. Amit, thanks so much for joining in and for speaking to us about ETFs versus index funds and how to buy the dip, and also for answering the questions that came through. Viewers, that brings us to the end of this particular edition of the Mutual Fund Show. Thanks so much for tuning in. There's lots to talk about over the course of the day. You'll find all of that right here on NDTV Profit.